All right, for adulting today, we're talking about credit cards. I think credit cards are a big fucking deal. As someone who is still trying to get better credit and to open credit cards, having good credit, managing your credit cards, understanding your debt, managing your spending, and being smart about it is a big topic. We spoke with Bola Sokunbi. She's the author and the CEO of the online financial platform called Clever Girl Finance. And she thinks that everyone should think about their credit cards as a financial tool.
One thing to remember is that the line of credit you have is not free money, and it is also not your money, and it comes at a cost, and that cost is interest. And so if you are using credit cards, your goal is to create a budget where you build in your spending that you're going to be using your credit card for, so that at the end of the month, you have the cash to pay back that balance in full. That's really, really important. That way, you're not carrying over a balance, because when you start to carry over a balance, then you get into a situation where your interest is compounding on the principal amount. And that can make it really difficult, depending on how that interest rate is compounding, for you to pay down that debt. And interest rates, depending on the fine print of the credit card, can compound daily, weekly, bi-weekly. It really depends. So you want to build your budget out first and how much you're going to be spending, so you know how much you're putting on your credit card, and then you have the plan in place to pay that credit card off.
So if you get into credit card trouble like I did, make sure you get yourself a plan for getting out of it and paying off your credit card debt. But before you do that, you may want to save up some reserve money first, because you don't want to have to keep depending on using your credit card.
It's really important that you have a baseline emergency fund in place. That way, if life happens to you, you don't take on additional debt to the debt that you already have. And a good baseline emergency fund to have is about $1,500, because this will cover your basics. It'll cover car repairs, an emergency plane ticket, your water heater breaks, whatever it might be. It will cover, it's a good baseline to have. And the way you save for that emergency fund is you build a line item into your budget called emergency savings, and you put a fixed amount every time you get paid into a dedicated account for emergencies, and you build it until it gets to that $1,500. Once you have that $1,500 in place, then you want to shift your focus to your credit cards. And you really want to create a plan to get ahead of the interest, because it's the interest that gets people stuck with credit. If your principal balance was never accumulating interest, it'll be really easy to pay off. But because interest is accumulating, a lot of people will make minimum payments and be like, wow, my credit card balance has not gone down by much at all. And this is because of how that interest rate might be compounding on your principal balance. So the key to paying off debt is to prioritize your debts in order of maybe the highest balance, the highest interest rate, or the smallest amount. It doesn't matter. Each one of these approaches work. The one that's going to save you the most amount of money is if you prioritize by highest interest rate, because that's what's compounding on the principal balance. However, you can just create a priority list of what's easiest for you to tackle. It could be the highest balance, the highest interest rate, or the smallest balance. And your goal is to take that priority one debt and pay as much more than the minimum as you can each month, while paying the minimums to your other debts. And by paying more than the minimum, that means that you're putting more money towards the principal balance and reducing your principal balance. And the next time the interest rates compounds on your principal balance, it's compounding on a smaller amount of money. That is the goal. So extra payments help reduce your principal balance, so that your entire payment is not just going to interest. And one really important thing when you're following this approach of paying more than the minimum to your credit card is to make sure that whatever extra you pay is actually being designated to your principal balance and not to interest. And you can do that when you log online to pay your bill, and it says pay extra to principal. You put the amount there, or you can even call customer service of your creditor to confirm that the extra money above your minimum payment is going to hit your principal balance. And so you want to also build your payments and your extra payments into your budget, so that you remember that you have this money designated to getting yourself out of debt.
So a lot of people say that to get more credit, you should open more credit cards to increase your overall credit profile. We asked whether this was a good idea or just a myth.
That is a very common scenario or idea that people have. And your credit score is based on a number of different factors. It's based on your credit utilization. So how much of your total available credit are you using? So by opening another credit card, it might increase your total available credit and make your utilization lower. But also creditors will look at your credit history, your history of payments, the type of debt you have, and they weigh this type of debt differently. So mortgage versus student loan versus car note versus credit card. They look at all these different factors to determine your credit worthiness. So opening a credit card may not necessarily be the solution to increasing your credits, but it can help. However, you have to keep in mind that when you open a new line of credit, you do create a hard inquiry on your credit reports, which can create a temporary drop of your credit score. So that's something to keep in mind as well.